Good afternoon. I can, with all confidence, say that I've never done this before. It's a pretty exciting weather event. I'm sure that our gracious hosts will tell us if we need to not, not have this session. So my name is Lisa McIntire Shaw, and you can't hear? Louder? I've never been told to be louder, but I can do it. So my name's Lisa McIntire Shaw, and I'm the Vice Chair for Programming for the Global Interdependence Center. On behalf of all of us, we want to thank you for being here, and we look forward to sharing with you some important insights to the economy. Next to me, I have Don Rissmiller, probably one of the smartest people I know. I've had the blessing of fishing with him in Maine and know him quite well. He and his team at Strategas are consistently recognized for their accuracy in economic forecasting. Next, we have Ellen Zentner from Morgan Stanley, where she is the Director of U.S. Economic Outlook and Managing Partner. I just met her today. Next, we have Bill Kennedy, who is the CEO of RiskBridge Advisors, another Camp Kotok fisherman, and someone that I hold in very high regard. So our format will be that each of our panelists will give just a few brief comments about what they think about the economy going forward. And as you know, there are lots of opinions. So each one will give a few minutes of their personal thoughts, and then we will have some questions. So we'll start with Don Rissmiller.
Ellen, did you want to, I think we talked that you wanted to go first. If
either way,
it doesn't matter. Okay, so I'll start off. So we had a planning call for this panel, and it was on Zoom. We did not anticipate a hurricane. So Bill and Ellen were right on time for this call. I was late. So as we've moved back to the office, I used to have my Zoom set up at home that I knew how to use. When we get back to the office, I now have the laptop, a microphone, a Wi-Fi headset, a Bluetooth headset, the speakers that are built into the computer, and I don't know how to use any of them. So it took me a while to get on this call. So sorry about that. When I finally did get on, took a few minutes, and Bill said, well, why don't you talk about forecasting productivity? We've decided you should talk about that. And since productivity is known to be very hard to forecast, some might say impossible to forecast, I said, okay, sure. Yeah, we'll give that a whirl. So let me describe what I see and what I think we can say about what is going on, and where I can contribute what I think is some interesting approaches. So what is the motivation to talk about productivity? Well, as Governor Waller said, long run growth depends on productivity in the labor market. It's output per hour and hours worked that get us to trend output. So it's very important in the long run for wealth creation, for understanding how we improve our situation. In the short run, it matters for inflation. And productivity, if it rises, would be all good. More output, less inflation. We have too much money chasing too few goods. One way to get inflation down is to make more goods. So it certainly matters there. There should be some motivation on that front. Also for investors, productivity is one of the key swing factors for corporate profits. If you look at the price unit labor cost markup, that will swing with corporate profits on a year-on-year basis, maybe not every quarter, but smoothed out over 12 months. So there's clearly the motivation to discuss this. Now, the problem is the data recently has been terrible. If you look at the first quarter number, the output per hour number was reported down 7.3% quarter to quarter annualized. So that's really, truly awful. That is a terrible performance. So what is going on? I'll offer 4 ideas. The first is, as has been discussed earlier today, the data could just be wrong. We may see revisions. These are numbers that have been released but will be revised. I don't think that's anything abnormal. There are many civil servants in Washington that try to put these numbers together as best we can, but there can be differences, discrepancies, and revisions. So we should just consider that this is not a number that's set in stone, but it's so negative that it's difficult to just say it's a data issue. Another possibility is it's reflecting the reverse mix shift of last year. So the early story in the pandemic was we were consuming lots of goods, not many services. Now we're starting to mean revert. If you look at the manufacturing part of the productivity data, that's not so bad. So there are some silver linings there. If this is a mix shift or a reverse mix shift, that's probably the most charitable explanation. This is just something that will work out over time. Essentially, we borrowed productivity a year ago. Now we're paying it back and it'll smooth out. A third possibility is this is going to play out with a lag, that we have seen shocks. We have seen a shock to GDP as reported, and we will see a shock to employment in the next 2 quarters, that this is simply out of phase. There could be some labor hoarding if employers have not been willing to part with workers because it was such a hard time to hire them. So I'd say that's medium charitable. Operating with a lag would say there's still some negative ahead of us. And the fourth most worrisome possibility would be that there's a true negative productivity shock. So my microphone and speakerphone and Wi-Fi headset are conceptually supposed to make me more productive, and it's making me less productive because I can't get on the planning call. And so I get assigned this topic. And so that's possible. It's possible work from home. It doesn't work. We've seen a big change in the labor market. People may be pretending to work from home. They may be at the zoo with the kids. It is so. I don't think the data is definitive on that, but I think that is the worst outcome, is that we are seeing a negative productivity shock that could last. And so there is an interesting model. If you want to Google con-rich productivity model, there will be a study that was done at the New York Fed about a decade ago. It's been updated regularly, but because productivity is so hard to forecast, there are good statistical techniques that have been developed to try to say, well, what do we think with some probability? So if we can't get the number exactly right, can we set up different regimes and try to say, what do we think we're doing? Are we in a high productivity regime or a low productivity regime? And right now, the model with the negative numbers that we've had is still suggesting that there's a probability that we're in the low productivity growth regime. So we can watch that, though. We can continue to monitor that model and the data to see if there's any change. And then the last thing I'd say is I think everybody in this room is going to have something to say about this over the next year or 2 or 3. Right? So if we have this conference next year or the year after, what does everybody here do in the next 12 months, the next 24 months? We are not powerless. We don't have to wait for some program or check or implementation. Everybody here can, in their business, in their line of work, with the people they interact with, try to increase productivity. There are things that everybody can do on a day-to-day basis, every company can do. And so it's not completely at the mercy of policymakers. There's a role for the private sector to help the Fed in bringing inflation down. And I think that angle is through increasing productivity. So let me stop there.
Perfect. Ellen?
Yeah, thanks. So like I'm the chief economist for the firm. It's dangerous when economists are asked to put on strategy hats. So hold on to yours. But I'm going to try to talk about 3 points that kind of couch the cycle in terms of how financial markets might interpret it. And I'm going to keep it to 3 points because Paul said to keep it to 3 points, but I did add 2A when I realized that there was a 4th point that I wanted to make. I also have to add, and again, this is for Chris's enjoyment. My husband gets suspicious every Fed meeting, that second day of every Fed, because I go to work dressed to the nines. And he likes to say, because your boyfriend is going to speak today. So but every economist is enamored by the Fed chair. Anyhow, so first point, right? We had a V-shaped recovery. I think when we came out with this analysis in 2020, it was met with a lot of derision, because at the time it was a very painful downturn and nobody liked to hear the talk of a V-shaped recovery, but it was a V-shaped recovery. We came out of that, out of the shortest downturn on record, straight into mid-cycle. And so it's been a very tough adjustment for private forecasters, for the Fed staff who are tasked with forecasting, for the Fed, for financial markets. Here we are, the Fed began forward guidance about removing policy accommodation 1.5 years after the downturn. That would never happen. What a short cycle. And so we'd argued that this would be a hotter but shorter cycle. So everything's been condensed. And I think that's probably most important as a backdrop here, right? Because if you came right out into mid-cycle, well, then as an equity investor, you've got to be thinking about rotation that you would normally see mid-cycle. We are already late cycle now. And so I think it's just been very difficult for financial markets to anticipate where things are going when the Fed's having to stop easing in the same month that it starts tightening policy. And in fact, still easing when they have to provide forward guidance about tightening. Now, what is inflation's role in this? So this is my point number 2, so you can stay with me here. So most recessions are preceded by accelerating inflation. I think we've forgotten that because we've gone through such a long period being able to be complacent around inflation. But most recessions throughout history have been preceded by accelerating inflation. And that's because there has to be a monetary policy response to that. If I think about, wage inflation also in this, I'm going to approach it from both a cyclical standpoint and a structural standpoint. So cyclically, wage pressures have been rising, very tight labor market. I think we've all agreed on that today. And so wage pressures have been rising. Things are working like they should, though. In sectors where jobs have been coming back and labor force participation has been picking up the most, wage pressures have been receding. So I think back to restaurants, where our restaurant analyst, John Glass, had told me starting back in March that they were starting to see a surge in applications for restaurants. And over the next couple of months, applications absolutely surged and wage pressures were coming off. Not that wages were declining, but the rate at which they were growing was slowing. And I think that's important because cyclically, wage pressures are acting like they should. Structurally, I think we are in a different environment where wage levels, the labor share of corporate income, is going to be permanently higher. And so this is something that we've looked into. Back in the mid-90s, there was an anomaly that happened. In the US, productivity split apart from its long-term trend with real wages. So whether you call it the lack of unionization, mega companies, everything that was tamping down worker bargaining power, this did not happen in Europe, only happened in the US. So you saw a big shift toward profits accruing toward corporates and investors and away from labor. Starting in 2015, so this was pre-COVID, we started seeing that relationship come back together. It's a demographic factor. It's a demographic shift. There's fiscal policy activism. There's COVID that's created more focus on inequality. But overall, this began before COVID, and it's demographics. And you can just look at companies like Starbucks and FedEx and some of the other low-income retailers, right, that have all made similar type of announcements of we're going to share more profits with workers, workers unionizing in Amazon warehouse, FedEx not going through the problems with drivers that UPS did because FedEx kept their drivers in-house. They did not contract them out, and FedEx's drivers are unionized. So this is a structural feature. And in our models says that margins will be 30% lower, period. Now that's playing out now, but this is a long-term feature. And this is modeling, right? So it doesn't mean that it's exactly margins across the board are going to be 30% lower, but there are certainly sectors that are going to be able to overcome that with capital deepening, driving productivity, and some sectors that aren't. But we're going back to what we think is the historical norm for the labor share of corporate income, that the anomaly was the last 15, 20 years. All right, 2A. Very simple here. So when I think about stagflation, just a couple of points here. We've been talking about stagflation since late 2020, when inflation really started rising. Certainly you can say this is a stagflationary environment since that time, right? Economists, which is why people hate economists, are so literal that at that time we were saying, what do you mean stagflation? You're crazy. We don't have negative growth with still sustained high rates of inflation. But that doesn't matter to markets, right? When economists are constantly revising down growth and up inflation, that's stagflationary, and markets trade at the same. And same for, is it going to be a soft landing or a hard landing? Do you think markets are going to trade it much differently if it's 0.5% growth on GDP versus minus 0.5% growth on GDP? I think you can get a different shape of the yield curve and things like that. But from an equity market standpoint, I'm not sure, the soft landing and versus hard landing is going to make that much of a difference. But that's why we've got you here. And so number 3, the biggest debate that I have with our strategists in the firm and some of our clients is reminding them that this slowdown in the economy is intentional. And so it's oftentimes difficult to understand, liquidity is lower, risk taking is being discouraged, the aggregate demand is slowing. Is this not intentional? Is this not the Fed's intent to create that environment in order to bring inflation down? And so it's difficult at times to discern where the sky is falling really matters, because to strategists, the sky is always falling if the equity market is down one day. And so I think that's been sort of difficult for markets to understand as well, is that a lot of what we're seeing is actually intentional. So that was 1, 2, 2A, and 3. And that's it for me.
Thank you, Ellen. Bill?
Thank you. So I am not an economist, and I don't play one on TV, but I do partner with these two and read their research. In our work at RiskBridge, we spend all of our time advising investment committees, insurance companies, endowments and foundations, could be family offices, just trying to help them think their way through risk issues, macro risk issues, asset allocation issues, and the like. So the only thing when we talk to our clients, the only thing we say now that we're certain about is uncertainty. And that's okay. The volatility and the turbulence that we have seen in the market is normal, and it is going to create that opportunistic window at some point. I don't know if it's in the next 6 weeks or the next 6 months, but it's coming. And so from that vantage point, we're seeing the slowdown, and it is a rate of change model that we use, not what is the absolute number of GDP, what's the absolute number of inflation, but what's the rate of change sequentially, month for month and quarter to quarter. And this, we're interpreting a very clear slowdown in terms of GDP momentum. We're a quarter early on our inflation call. We thought that we were starting to see it slow down. That was clearly wrong, but eventually we're going to be right. So we're going to stick with that call. So the one thing I would highlight, just to follow up on Ellen and Don's comments, when we talk to some of our clients, we just explain the environment that we're in. Just imagine somebody for years came knocking at your door every night and delivered a free pizza. Every single night, knocked on the door and delivered a free pizza. And then suddenly they knocked on the door empty-handed and they demanded that you make them dinner. That's the market environment that we're in today. The freebies that have been handed out that enabled companies, certain companies, to get access to capital that they probably didn't deserve. That's what's normalizing. And we think that is going to create a pretty robust and interesting investment environment as we go forward. And just to wrap this, my third point, or maybe 2A, this is creating dispersion. That difference between the winners and the losers in the marketplace is becoming more and more evident. And that's true in the credit markets. It's true in the equity markets. And that's where we're kind of excited about the opportunity when we look out over the long term, say over the next 2 to 5 years.
Bill and Ellen, you've calmed the market gods. So thank you.
Yes, and I'm very grateful for that. So it's, are we going to take audience questions? We can, okay. Hold that idea. So first, I would like to ask a couple of things of our panelists. Number one, Ellen, tell us what your thoughts are about the depth and length of this recession, if it is a recession that we're in, you know, just give us a sense of time and impact. And I think that it's very interesting that, yes, we should do something now, but it's very hard to determine what that is. Hope is not a strategy. So how long do you think this will last?
Good. So I will say, John, and you'll still love me after this, I don't think that we're in a recession now, but recessions are inevitable, right? So what we're debating is when, okay? But the size and shape of it will matter. Now, I do think that it can be a shorter lived cycle. Now, why is that? For two things. I do think that the Fed will be in a better position when we enter a downturn in order to provide more monetary policy offset than they have in the past. In fact, I don't believe that they need go back to the zero lower bound. And that in itself will be a miracle, right? That you don't get trapped forevermore of revisiting the zero lower bound in every cycle. The other reason why I think that it would be shorter is because typically what creates lengthy downturns and very sluggish recoveries is exactly what happened after the GFC, a deleveraging cycle on top of a recession. So a balance sheet recession on top of a recession. There's no need for that this time. Households, you know, yes, interest rates are rising. It has a big effect on housing. It has a big effect on durable goods spending. It's making the cost of credit go up. It will slow aggregate demand and is already slowing aggregate demand. But that knee-jerk reaction on the part of households that have very large balance sheets exposed to a variable rate is just not there. 97% of all outstanding mortgages today are being held at a 30-year fixed rate. The effective yield on all of that is 3.4%. And we just have very little debt on the balance sheet that is subject to a variable rate. On the corporate side, we were worried ahead of COVID that corporates would create the next downturn because they were very exposed and had a mountain of debt that was due to be rolled over. And we were worried about the BBB share of corporate credit within the IG space. And COVID gave them the gift, right, of being able to refi at very low rates. And now that wall of debt has been put off by about 6 or 7 years. So you don't have a balance sheet recession on top of a downturn. So that means it can be shorter. In terms of the depth of it, I also, I believe that it can be sort of whatever we want to call garden variety, like say a 2001, because the Fed does have more monetary policy space for easing. But I want to give a caveat here. I have been meeting with a good deal of government folks that are really focused on automatic stabilizers here. And so I'm learning more about automatic stabilizers or the lack thereof in the next downturn. So we have 18 programs that are tied to this emergency health declaration that HHS has us under. And that means that 42 million people right now are maxed out on benefits, maxed out. You can't max them out even more when we go into a downturn. And they're maxed out to the tune of, maybe these 18 programs were about 50 billion before COVID. Now they're 150 billion in cost. So look, unemployment benefits will still be there, and those are still automatically triggered by the unemployment rate in each state. But these other programs actually are worth a lot more than unemployment benefits. And so I just put that out there as a caveat that we don't really understand the full extent yet to how that might dampen the automatic stabilizer that we have on the fiscal policy side when we go into the next downturn. HHS has said that they'll give the states 2 months notice before they halt that emergency health declaration. But, it's something that, again, we just don't understand a lot about yet. It's where my team is spending a lot of their summer. They love me looking into this, but I'll just throw that out there as one caveat.
So you think it won't last quite as long? You're hopeful that it won't last quite as long.
I guarantee you it'll last longer probably than the COVID downturn, which was 1 month or 2 months. Yeah,
Perfect.
I'm sure it'll be longer than that.
Perfect.
Yeah.
Perfect. Don, Ellen kind of bridged to a good question about bonds. She was talking about investment grade bonds and so forth. And I'm wondering about bonds in the sense of, are they a good economic indicator? Do bonds work right alongside inflation, or what can we expect in the bond market?
Yeah, Lisa. So I think the bond market's challenged by the same thing everybody else is. We're trying to figure out what this is. So if it's not a recession, it's something bad. I mean, we have the record low in the University of Michigan consumer sentiment number. We have an inverted yield curve. We have rising BAA spreads. We have PMI new orders below 50. We have housing permits look like they might be topping and mortgage rates are up. So that's probably coming if it's not already here in the housing sector. So there's something happening here. And if it's not going to be a recession, then maybe there's a lag. So in the early 1980s, it was 3 years and 2 recessions before we finally anchored inflation expectations. But I think what the bond market's looking for is, have we anchored long run inflation expectations? And in the pre-Volcker years, the bond market seemed like it needed to see it. Sometimes the CPI would peak before bond yields. And then in the post-Volcker years, the bond market was more of a leading indicator. Yields would come down well in advance. So maybe we're struggling in the bond market with the same thing we're struggling with in this room, which is, okay, if this isn't a recession, it's something cyclical, and getting through that is its own challenge. But then there's the lagged effects of what we're going to ask the economy to do, and maybe we have to get through that too. But the ultimate goal is to anchor inflation expectations. And once that happens, it's a great jumping off point. Once we have better valuations and actually some yield and fixed income, that's an interesting entry point.
And that perfectly leads me to my question for Bill. What are you telling your clients should be their proper asset allocation? When we look at returns, there's no safe place this year. The only people in the equity markets who made money were either 100% energy or 100% cash, or 50-50 energy and cash. So there's no safe haven in 2022. It's been, of course, real estate. A lot of people have made money in real estate, but for your clients, how are you telling them to allocate their money? And I'm not talking about just, from now until the end of the year. Let's think, a year, 2 year, 3 year time horizon.
Yeah, so our advice is 3 points. I think we've heard it already from Paul McCauley, and it's think long-term, be opportunistic, and let us manage more of your money. Amen. To that point, so our insurance clients, for instance, all fixed income, it's trying to help them think their way through 2 problems. First of all, when should they start extending duration, taking on more interest rate risk in their portfolio? And we are starting to advise to do that today, to extend duration a little bit further on the expectation that soft landing or recession, that rate of change comes back into play. We're going to continue to see the rate of decline in economic activity be with us for an extended period of time. The other thing, the insurance companies are having to think their way through. The losses that we've had this year on the long end of the, or long duration part of the treasury market are double digit. There are insurance companies that are suffering capital issues now because of the losses on their fixed income book. Their underwriting business is doing great, but on the asset side of their business, they're starting to struggle with some of the capital charges in the mark to market. So for our more diversified clients, the way that we are positioned today is underweight equities with an offset to cash, so a corresponding overweight to cash. We have taken fixed income to a neutral position from underweight position for the first time in years, in part because of the rate of change in economic activity. And we believe that we're getting to a point where once inflation normalizes, whatever that is, 3%, but we're getting close to a real yield in fixed income, which we haven't seen for a while. And then we're overweight in what we would consider diversifiers. And these are things in the infrastructure space, things that have a low correlation to public equities and public fixed income, and sort of idiosyncratic, niche-y type of investment opportunities.
So just to repeat, you would be underweight equity, neutral weight bonds, and overweight, for lack of a better term, alternatives.
Correct.
Of some kind. Okay. Don, your group does a lot of work in that area as well. What are you telling your clients about asset allocation?
Yeah, I guess what I see is, so there's the balanced portfolio, typical asset allocation strategy, and that's losing on both sides right now. That's the problem, right? So the bond market and the stock market are both coming under pressure. And I guess what concerns me is that people are treating this almost like a software upgrade. They're like, okay, well, my old software doesn't work. Let me download the commodities patch and add that to my balanced portfolio, and that'll help. And that's okay, but I think that throws your Sharpe ratio way off. I mean, if you're going to add the commodities exposure to your balanced portfolio, just be aware you're going to swing around, as I think we're seeing in the oil market and other commodities right now. I mean, these are a much different asset class. So I think that doing the hard work on the diversifiers is really important in this this framework. It's not as simple as just adding commodity exposure to a 60-40 balanced portfolio here.
We have a question in the back, and I am happy if you have you can either speak loud. Yes, perfect.
Gets to is what is that signaling in the future of the economy, and is that signal really a signal of a lot of creative destruction to come? And I sort of make a context from the standpoint of in the early 1900s, as radio and TV and telecom came on, there was sort of a secular shift in the enabling technology, and we saw a lot of productivity gain. Now, how much of that's hiding in the background, and then as we start delevering and cash is less available for corporates, what are they going to use to really sort of drive, since they've sort of been a park on innovation across the board?
Yeah, I could offer some thoughts on that. So the key is to whatever technology we have to get it to business process. So we seem to be doing something right in manufacturing. It's in services where we've had trouble. And this is notorious that we have trouble in productivity and in services. So the economy seems to have been doing a good job with technology at increasing consumer surplus really for the last decade. This isn't new, right? So the problem is that's not the same thing. It's a thing. It's an interesting thing. It's a thing you might want, but we have to take the technology we have and get it to business process and increase output per hour rather than increase the variety of choice of the same thing. So for instance, go to the supermarket and my kids like those toaster waffles. They're really easy, really quick. But you get to the supermarket and there's like blueberry, raspberry, gluten-free, home style, unicorn. I don't even know what unicorn waffles are, but there's not more waffles per hour. There's just more variety of choice of the same product to fit your niche taste. And so I guess the big inflection point, I think, will be when we switch away from things that increase consumer surplus, like using technology to watch cats on the train on the way to work, and change business process. And that's been slower, but it's possible it's still ahead of us. And that's where the opportunity sits.
Yeah, so it's hard to camp on this. So we're seeing that so we're a venture fund, we're up 30% in the last 6 months. So I guess that's a nice thing of being liquidity, but it's all in ag.
We'll have you on our panel another.
Well, I'm on tomorrow.
Yeah. Oh,
but,
good.
But the point is, it's in ag, and we're driving huge productivities and gains in ag that nobody's catching on. And we're seeing similar things in other sectors that have not seen that TFP hike. And are you picking up any signal that that's coming? Because it's really sort of data enablement of those business models.
Yeah, I think if that's going to happen, it's ahead of us. And I would think that's a huge opportunity, because that's not what we've done. That's not what the data has shown really for the last decade. The aggregate data has been relatively weak for the last decade, disappointingly weak. And the data this year has been terrible, just outright terrible. So if there's work that can be done like that, I love it. That's the pathway forward. That's the way the private sector helps the Fed get us out of this much, much faster.
It's an excellent question, and a lot to think about. Those cat videos on the way on the train, and it seems
They're nice. They're just not productive.
They're just not productive. It's not adding any value. Ellen or Bill, do you have any thoughts on that?
I'll just say, total factor productivity for economists, it's the most difficult piece to forecast in terms of the specific component of productivity. In 2010, we were looking at this where you had some billions of dollars that were going into R&D, but for some reason, productivity was flat on its back. And the only explanation we could find when we saw that a lot of it was in consumer discretionary, and we were like, well, what the hell is that? It was all Amazon developing their one-click technology. And we're not very good at understanding how do we translate that into productivity. So TFP could be much higher than we think, and we just don't know how to capture that amenity value too. And should we be capturing? Should it even matter, right? Because I can now buy something on the way to the bathroom rather than wasting time at home. I can stream more TV because I've already bought, whatever I needed on the way to the bathroom with one-click technology, which is what Amazon at the time was spending on. So that makes my life better. I get to enjoy more minutes of my day, but is that a productivity enhancer? And some could argue that whatever this cats on a train thing is a productivity, detractor. I used to actually read stuff on the way to work, and now I just looking at Instagram.
You're not alone.
Yeah.
Definitely. Bill, did you have a thought?
No, just a sidetrack, if you will. But when we talk about diversifiers, this is exactly what we're referencing, to try to find opportunities where the revenue is going to grow exponentially faster than nominal GDP, and areas where we think it's going to be transformative. And so much of that happens in the infrastructure space, in digital infrastructure, for instance, and that whole ecosystem. It sounds like this gentleman's venture fund is right in the heart of that.
Absolutely. I'm looking forward to his talk. I want and meeting you. I have just one final question, unless there's anybody in the audience that has something that's on their heart that they need to ask. My final question, and thank you again to all three of you. It's really an honor to be on the stage with you. What is the catalyst? What should we be looking for as the one, maybe it's two or three, but what is the one thing that is going to show us that things are changing? Or if you think there are two things, is it, as Bill already said, the market hates uncertainty. So there are lots of reasons we can express why this year happened the way this year has, but what's going to change it? What's going to realign both the equity and the bond markets to some positive returns? Do you all each in turn, and we can go from Don to Ellen to Bill.
Okay, I'd say I would like to see long-run inflation expectations anchored. So if the employment cost index starts going sideways instead of accelerating, if rent inflation starts going sideways instead of accelerating, if 5-year forward tips, which have been relatively anchored, stay anchored, I would view that very positively because I think that's the interesting jumping off point for everything good in the future.
Yes, I think something else that John Sylvia said earlier, when inflation expectations, say 12 months forward, are falling and they fall to say around 2.5% or lower. So again, going back to inflation, because I think that's our biggest focus. I think for markets, it's the biggest focus. I think that that's where the sentiment changes. And I mean, changes for everyone, changes for the Fed, changes for markets. Markets are forward looking. You don't need to get down to the Fed's goal of 2%. The Fed doesn't even need to get down to the Fed's goal of 2% for that to change. And I think the reason why that's so important for markets is just that in terms of, if it's going to, whether it's going to be a recession or not, you want it to happen sooner than later. You don't want markets to be in limbo for even longer. But if we're going to avoid recession, then something where it's something definitive on inflation has got to be there. That's the market perspective. The economist perspective is labor force participation. Give me a faster pickup in labor force participation, and I'll tell you that it solves a lot of illnesses for everyone.
So it's one, but there's 3 subparts. It's the entire volatility complex. So it's the VIX index getting to 20 and below and staying there. It's the MOVE index, which is the volatility of interest rates, normalizing back to some historical average. And probably the most important one is the US dollar. To me, the US dollar is the canary in the coal mine for that uncertainty. And we've seen nothing but dollar appreciation, which is going to be very challenging for US corporate earnings. And it is disinflationary. I'm sorry, will be disinflationary. It will help address that. But until we see equity volatility, interest rate volatility, and currency volatility normalize, we're going to stay somewhat cautious.
Thank you all. I learned something. If you also learned something, please clap your hands in appreciation for our panel.